Hello, and welcome to the Joss Brown Podcast. With over 40 years of combined financial planning experience serving high net worth clients, we will discuss our favorite topics, concepts, and stories.
Hello, and welcome back to the Joss Brown Podcast. I'm Philip Saunders.
I'm Dan Joss.
And today we're going to be talking about a couple different things.
That's right.
So, elections, presidential elections, namely, and then also Fed rate cuts.
Right.
And so, these are two articles by Dimensional Fund Advisors that talk about what these things mean and how to invest accordingly. And so, what we find in the presidential election article is that it really doesn't matter who the president ends up being, because the stock market is pretty much disconnected to that. I don't know, I may have said that crudely. It's not completely disconnected to that, but we don't see, here's a better way to say it, we don't see a clear correlation between who gets elected and what the stock market does. How about that?
Yeah, we can't tell the future.
That's an easy way to say it. There you have it, folks. And so we have the different...
And similarly, the Fed rate cut.
Exactly.
If they cut, what will happen? Well, it's a guess.
And so that one there, Dimensional says, okay, well, when the Fed funds rate increases, 65% of the time the 10-year yield also rises, but 35% of the time the 10-year yield falls. And then conversely, when the Fed funds rate decreases, 64% of the time it also decreases the 10-year yield. And then 34% of the time the 10-year yield rises instead.
And that's what happened this time. So why we wanted to talk about these two together was because they both happened around the election time. People were guessing who was going to win the election and what would happen with their stocks or what they should do in response to that, or maybe ahead of the election, hoping that one outcome would happen and then something would happen in their portfolio. And the rate cut. The sentiment for the rate cut was they cut again, and they're gonna cut in December. Well, now there's close to a 50% chance of a cut in December. So the plan from 3 cuts before the end of the year is now maybe 2.
Yeah.
And you throw an election in there, just shows you how complicated trying to guess the future is.
Macroeconomics is tough, isn't it? I struggled with that one in college.
Which is interesting. You mentioned the Fed fund rate decrease, which is what they did, and the 10-year, I think, went up, which happens 1/3 of the time. So it's not so unusual.
Okay.
It's just less than average.
Right. Yeah, but it's interesting. Before all this happens, a lot of people will, sell bonds and go to cash, or wait, in cash before they invest in bonds.
Or wait to buy a house because they're going to lower the rates and our mortgage rate will go down, and this time the mortgage rates went up.
That's interesting. Yeah, you're right. That's a lot of people are saying that, yeah.
So you wrote out the president and the returns, right, and you said it was kind of a little history lesson. What did you notice?
Well, it was a lot of reminders of
the good old days,
the president, and just a lot of things from world history that I had forgotten, or U.S. history. But like I said, so something that we noted was 3 out of the 17 terms between the president terms of Coolidge and Biden, all the way to Biden. 3 out of the 17 were negative. The rest were positive.
So in Ford's case, it was 2 years, and in others, it was 8 years.
Exactly. Yeah, so that was a little history lesson. I forgot who Ford
So if
was.
you look at 4 years or 5 year returns as a whole, as a big chunk of time, only less than 20% of the time the stock market is negative.
Exactly.
That's a great lesson. Be in it for the long run.
Yeah.
And if you're in it for a whole president's term, 80% chance of positive returns in the stock market.
Yeah. And it may be negative, but
you know what they say.
Wait a little longer.
History doesn't repeat itself, but it rhymes a lot.
That's right. That's right.
So we could say, on average, well, you have the averages here. One party averages higher than the other party, but you don't have the standard deviation there. That'd be interesting.
That's a good point. Yeah, I didn't think to do that.
So stay invested during the highs and lows. You're investing for your future self, not today. Invest globally, so you don't have country risk. And then have the right risk in your portfolio. And you do that by having more or fewer high-quality, short, intermediate-term bonds.
Right. Yeah, so I think we brought that into the equation because when you think about retirement or just your portfolio in general, it's, oh, well, this president got elected. Now, my whole portfolio is going to be affected. And that may not be the case. So if you're allocated some percentage to stock, some percentage to bond, great. That means that some of your, allocation will be affected. Some may not. And then if you're allocated some to U.S. and some to global stock, also bonds, global bonds, then that just makes you a lot more prepared for the storms that may come.
And I hadn't thought of this ahead of time, but, well, we do know that stocks on average 2 out of 3 times, so the same 60%, outperform bonds in any given year.
Yep. Yeah.
And I remember 2014 and 15, the market kind of went sideways. 2007, 8, 9 was the housing 40% decline in equity. Mm-hmm. 2000, 2001, and 2, that was a 40% decline in equity. So I remember those times, but I don't remember who the president was. Right? Because we always remember when the market, but we don't. I wouldn't arguably assign blame to the president. I think the president caused the housing debacle. Well, it probably had been in the works for months or years before that.
I guess it was 08 Bush. That was Bush, right? I should have put the dates here. Obama got elected in 08, so I think it was Bush then. But you're right. When we talk about 08, it's not a lot of people. It's not Bush. It's the global housing crisis.
And the incentive was to push banks to give loans to people that ended up not being able to pay them. And leverage is dangerous. That's a principle.
Yeah, exactly.
That survives any presidency.
There you go.
The use of debt is dangerous.
Spend less than you earn. Yep. Don't get too much debt. Yeah, so I guess to sum it all up, and if you have anything else to add, by all means, but it's just that a lot of the news that you see and things that you're watching on TV don't always affect your portfolio the way you think they will.
That's right.
Yeah.
They'll affect your portfolio. That's what I thought was interesting about this one was so much attention on what the Fed was going to do with the interest rates and the election at the same time. To say, well, this was the cause of that is impossible to say.
Absolutely. Yeah.
So just relax, build a portfolio that's diversified, appropriate amount of risk for your goals and for your capacity for risk and your tolerance for risk, and then rebalance periodically.
Have some cash on hand.
And pay attention to taxes.
Absolutely.
Good.
Yeah. All right. Well, thanks for listening, and we'll see you next time on the Josh Brown Podcast.
Thank you for tuning in to today's episode of the Josh Brown Podcast. If you'd like to see more episodes, visit our website at joshbrown.com.